Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday, the 9th of June 2020, and yesterday we produced a video entitled World Bank Paints Gloomy Picture for 2020. And on Monday, is China still the future? And we've placed links to both of these in the description box below and suggest if you haven't listened to them, please do so, as they are quite interesting articles that normally don't tend to hit the headlines in the main. Now today we're going to cover two articles again published by Bloomberg, and we apologise we're using Bloomberg quite a lot, but there are some interesting things appearing on it quite lately. But the two articles appeal to slightly different investor curiosities. Now the first relates to how governments actually manage to raise funds in order to pay for the stimulus programs they have promised via the markets, and who is actually buying the paper that they're selling in order to do so, and how perhaps to some degree this is not likely to run out anytime soon. The second is a cautionary warning that equity markets may now be reaching their medium-term zenith or peak or top. So first, let's take a brief look at the article concerning government funding. Bloomberg article dated 9th of June 2020, 4:08 p.m. GMT +1, headline: Why Europe had to get creative to pay pandemic bills. The coronavirus crisis is forcing countries to think differently to fund their responses to the steepest recession since World War II. With nations rushing to meet the financing needs, many, especially in Europe, are not taking any chances for fear that the glut may result in spiralling interest costs. That's leading some to take the less trodden path of selling bonds via a route known as syndication, a relatively costly but nicely predictable option. 1. What are countries doing differently? The typical method in Europe for raising funds is via an auction. Think Sotheby's, whereby a country sells an amount of debt at a given time on a given day. Like at an art auction, investors make bids and prices fluctuate according to demand. Far less common is the private placement, in which debt management offices sell directly to investors, often for more obscure issues such as a 100-year Irish bond. The other way is via syndication, which involves appointing a group of banks to underwrite a sale. Syndications have largely been used to introduce new or ultra-long bonds to the market and have become a popular choice for funding coronavirus recovery plans. They cost a nation more, but are guaranteed to raise the cash. How do they work? After a country's treasury works out its borrowing needs, its debt management office plans how to fund it, usually through a mix of auctions and syndications. The latter involves finding a set of banks who will take responsibility for securing investors, who agree to purchase any unsold securities. There is a premium to pay for the luxury of knowing the full stash will move. A recent Italian syndication racked up more than 100 billion euros, or the equivalent of $113 billion, of orders, mainly because the bonds were offered with yields nearly 10 basis points more than those in the market. The process is a highly profitable one for banks, assuming they manage to sell everything. 3. Why are countries doing this? Europe is facing unprecedented borrowing needs. Bond sales across the 19-nation euro area are set to total around 1.2 trillion euros this year, according to Bloomberg Intelligence, up from around 870 billion euros in 2019. And with countries still easing their way out of lockdown, governments cannot afford to come up short in providing the desperately needed support to businesses and citizens. Conventional auctions can be unreliable, potentially failing to sell all the bonds on offer, and hence the demand for syndications. JP Morgan Chase & Co. estimates they account for around 30% of this year's government debt issuance, a third more than usual for the time of year. 4. Can investors digest all the extra borrowing? For now it seems like they can, and then some. Sales across the region have attracted record demand, largely thanks to the European Central Bank. While the institution cannot buy bonds straight from a treasury, its growing presence in the secondary market means that investors know they can always offload securities. At its June meeting, the ECB increased its pandemic purchase program to 1.35 trillion euros. This doesn't guarantee syndications will continue to be met with strong demand, of course. A second wave of the coronavirus pandemic, for example, might make such sales more challenging for indebted nations such as Italy. 5. How does this compare with the rest of the world? Syndications are often used by companies to sell bonds, as well as by emerging market nations, regional governments and development funds. But the world's biggest seller of bonds, the United States, doesn't offer them at all. While the US Treasury has considered syndications, citing the success of other countries, concerns have been raised over the possible appearance of playing favourites with particular banks and to disrupting the predictability of market supply. What's more, there hasn't really been a need. The status of treasuries as the world's largest and most liquid government bond market has underpinned demand, including from foreign investors. 6. Are there wider implications for the bond market? Right now, the syndication process is working. Even on a day when the UK, Spain, Ireland and Greece all conducted such sales, investors laid down nearly $300 billion of offers, showing that fixed income demand is remaining robust for the time being. There may be longer-term risks to how the market functions, with central banks mopping up so much of the supply. Japan's central bank has been devouring bonds to such an extent that there have been days when not a single bond traded on the open market. If Europe went the same way, a bigger proportion of the day-to-day work for rates desks may be conducting profitable syndications rather than actually buying and selling securities. The danger is liquidity could all but dry up. Okay, we can clearly see that as things stand, at least for the moment, the various initiatives, or shall we say papers sold, can for now continue to be sold, and its demand seems relatively insatiable in order to ensure the continuance of government spending. Now, of course, we all know this cannot go on indefinitely, but there appears at least little concern at present. Now, that said, with such vast sums having been spent by governments and central banks pumping liquidity into the economy, much of it helping equity markets, it's now worth noting that some serious investors and advisors, and economists as well, are growing nervous. Let's just take a look. Bloomberg article dated June 9th, 2020. Published 11:02 a.m. GMT +1. Signs stock rally is doomed to end after $21 trillion rebound. As a sense of euphoria sweeps through global equity markets, propelling stocks to regain $21 trillion in value from a March low, the asset class is looking increasingly frothy. While stock luminaries who had advocated for a bull zone look like winners in hindsight, the debate goes on about whether the rally is a bear market bounce doomed to end. Asia ended the day up, but off the session's high, while equities in Europe slipped in early trade, with the Stoxx Europe 600 falling as much as 1.6%. It's a similar picture for the US market, as S&P 500 futures were down 0.9%. Global equities have climbed back to levels last seen in February, when the coronavirus began spreading rapidly outside of China. The 42% surge from a March low is the best advance over an equivalent time frame since 2009 for the MSCI ACWI index that includes stocks in both the emerging and developed world. The gauge is now trading at 20 times next year's profits, the most expensive since 2002. This rally is a function of government support being thrown behind the economy, said Paul Sandhu, head of multi-asset quant solutions and client advisory for Asia Pacific at BNP Paribas Asset Management. There are key risks that could lead to more volatility ahead over the short term, which is why we continue to hedge our portfolios on the downside while still looking for opportunities to add risk for the medium to long term. So far, bulls are in charge. US stocks just crossed an important psychological milestone of recouping this year's losses. Asia's equity benchmark just posted its 7th straight day of gains, the longest streak in more than 2 years. And euro area shares are on course for their best monthly gains since 2015. Factors including a wall of money from the guardians of global economies, the easing of lockdowns, and the shockingly positive employment numbers in the US are drawing more buyers to participate, picking up cheaper sectors and adding more fuel to the rally. Yet caution still abounds with some investors increasing hedges for potential volatility ahead. The risk of a correction will rise if investors continue to price in a rapid recovery, especially for sectors that are vulnerable to another wave of infections or an escalation of tensions between the US and China, said Tai Hui, Chief Asia Market Strategist at JP Morgan Asset Management. In another sign that the rally is stretched, global share price gains in the past month have purely come from multiple expansion, as earning forecasts have barely budged since May. Adding to that is the fact that the MSCI World Measure has been in overbought territory since the start of the month, with the relative strength gauge on the index reaching the highest since January, which is considered a bearish signal by some. Meanwhile, speculative excesses has surged to the highest in at least 20 years among US option traders, a negative for stocks over the medium term, according to Sundial Capital Research Inc. And a time-honoured strategy of hedging stocks with government bonds has become questionable now that bond yields have plummeted thanks to policy easing across the world. If everyone is holding stocks just to pass on to the next greater fool, and if the greatest fool is a central bank with infinite liquidity to buy them, then yes, prices will keep going up, according to a note from Rabobank on Tuesday. Now, whilst we've been in the financial services industry for over really 40 years now, there is no doubt in our minds that basically anyone who says they can accurately predict both the direction and the limits of equity markets are perhaps deceiving you. That said, there are very often telltale signs that broadly will give you the general indication of which direction those markets are likely to move in. And of course, with various tools, such as technical analysis and other variants thereof, individuals, experts, investors can to some degree at least give a moderate guidance as to where they're going to land. What is interesting about this one is, of course, that it was not that long ago where you had the Dow Jones just about touching 30,000, then collapsing to around 17,000, and now at the levels that it's at in past mid-25,000s. So no one can predict where the top is likely to rest and at what period in time it's going to hit the latest top and then fall back. But what is certainly the case, and that's really when one gets into the weeds and starts studying earnings and earnings per share, etc., and price to earnings ratios, when one actually goes about and undertakes that, under normal circumstances in the past, one could have a pretty good idea. But with such vast levels of liquidity and investment going into the economy, it's extraordinarily difficult to predict. However, it will be right to say that what goes up must come down, and that continuing peaks cannot go on forever. Now, interestingly, if we take a brief look at today's figures, which were doing very well in the equity front. Now, we're producing this podcast video at 20:05 GMT +1. European markets, though, closed broadly down between 1% and 2%, and US markets have fallen back a little, and they're down between 0.5% and 1.5%. We have a continuing fall in the dollar, nothing drastic, but moderate, of 0.3, so the dollar index is now 96.32. Gold is up to $1,732, but silver is down slightly at $17.60. But as we stated yesterday, we will see vacillations in both these prices. Now, tomorrow we have the FOMC decision on interest rates and Jerome Powell's press conference thereafter. And what is covered tomorrow should give us a relatively clear guide as to what will happen to both equities and precious metals for the next week or so, if not longer. So meanwhile, if you have any comments you may wish to make, they would be most welcome. Thank you for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.